How much money does Vanguard make? And is there trouble brewing beneath the surface of this brokerage behemoth? Hello, member Super Savers and Barn Course fans. I hope you're having a good week. And welcome to part 3 of our mini-series on some of the US's largest brokerage houses. As requested, this one is for the Vanguard folks. For Schwab and Fidelity folks, I've linked these previous Schwab and Fidelity deep dives in the first pinned comment below this video for you. Here are the 3 topics that we'll be covering in today's Vanguard video. 1. Who owns Vanguard? 2. How does Vanguard make its money? And 3. How is Vanguard doing relative to Fidelity, Schwab, and Blackrock? And what challenges may lie ahead? New fees, new CEO, and maybe a new direction. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Vanguard was founded by the legendary and much revered Jack Bogle in 1975 and has its headquarters in their own dedicated Vanguard campus near historic Valley Forge in Pennsylvania, not too far outside Philadelphia. Like Fidelity, Vanguard is privately held, but unlike Fidelity, Vanguard is not family owned. So it's not owned by Jack Bogle's family or descendants. Vanguard has quite a unique ownership structure. The Vanguard Group, Inc., the ultimate corporate parent, is owned by Vanguard's member funds, which in turn are owned by Vanguard's fund shareholders. Meaning that if you own a Vanguard fund, you actually also own a piece of Vanguard, even if that piece may be a very tiny bit if you only have a few thousand invested there. Having many indirect shareholder owners alone doesn't make them a public company, however. They remain a private company in the eyes of the regulators. As a refresher, here are 3 key characteristics of a privately held company like Vanguard. 1. Vanguard shares are not publicly traded on any stock exchange, meaning you and I can't just go out and buy Vanguard stock on Vanguard's platform or via any other broker. And because of this, 2. Vanguard is not legally required to make its financial and other information publicly available, meaning that 3. We only know as much about Vanguard and its finances as it wants us to know. These are, at the same time, some of the main reasons why companies sometimes choose to stay private. If you want a deeper dive into any of these points, please refer to the first part of this Fidelity deep dive that I referenced earlier, linked below. As I mentioned in that Fidelity video, Fidelity does choose to disclose some numbers voluntarily, even if those numbers are not nearly as detailed as the information published by publicly traded asset management companies like Schwab and Blackrock. Vanguard, on the other hand, with its unique ownership structure here, is quite intransparent. And as far as we can tell, most, if not all shareholders in a Vanguard fund have never seen any detailed financial information about the firm they indirectly own, nor have they ever been asked to vote on any resolution on behalf of the Vanguard Group, Inc. It almost seems that Vanguard belongs to itself, and only its management knows how they're really doing. So it's much harder to find any reliable information about Vanguard as a firm than it even was for Fidelity, as Vanguard has chosen to not disclose much at all voluntarily. But as the regulars on our channel know, we are pretty good persistent detectives here at Diamond NestEgg. So let's walk through what we were able to unearth, piece together, and decipher for our Vanguard folks. Here's how Vanguard makes its money. Vanguard's main business line is their famous low-cost index funds and ETFs that they sponsor, launch, and manage. Vanguard and Jack Bogle actually made their names as pioneers of diversified low-cost investing for the broad public, like you and me. These index funds and ETFs are sold both to Vanguard's own clients and on the open market, meaning you can buy them from Schwab, Fidelity, and other brokerage platforms as well. Their flagship funds include the Vanguard Total Stock Market Index Fund, ticker VTSAX, with total assets of $1.7 trillion and an expense ratio of 4 basis points. The Vanguard 500 Index Fund, ticker VFIAX, with total assets of $1.2 trillion and an expense ratio of 4 basis points. The Vanguard S&P 500 ETF, ticker VOO, with total assets of $478 billion and an expense ratio of 3 basis points. The Vanguard Total Stock Market ETF, ticker VTI, with total assets of $405 billion and an expense ratio of 3 basis points. And the Vanguard Total Bond Market Index Fund, ticker VBTLX, with total assets of $330 billion and an expense ratio of 5 basis points. And these index funds and ETFs are also the primary reason why Vanguard is the second largest asset manager in the world, with $9.3 trillion in assets under management as of March 31st, 2024. This puts them right behind BlackRock, and as you can see, both BlackRock and Vanguard are ahead of their competitors by a margin. As a second business line, Vanguard also offers brokerage accounts to individual investors with a general focus on low-cost, diversified investing for buy and hold investors via their own index funds and ETFs here. Like Fidelity, but unlike Schwab, Vanguard does not own a bank or hold a banking license. They do offer the Vanguard Cash Plus account for those investors who don't want to park their cash in money market funds. But it doesn't keep the cash in-house. Instead, it sweeps that cash into FDIC-insured partner banks. From what we can see, Vanguard does not seem to be as big a player in other business lines, such as Fidelity is in retirement accounts, or both Fidelity and Schwab are in custody and execution accounts for RIAs, registered investment advisors. So, now that we know how Vanguard makes its money, let's go through the numbers that we were able to dig up for you to see how they compare against their key competitors and what troubles may be brewing beneath the surface of this brokerage behemoth. Here's how Vanguard is doing relative to its competitors. In this column, we have Vanguard, and the other brokers will be comparing Vanguard to. In this column, we have the assets under management for each company at the end of the first quarter. As we touched upon earlier, with $9.3 trillion in assets under management as of March 31st, 2024, Vanguard is right behind BlackRock and larger than both Fidelity and Schwab combined. Now, this ranking is based on assets under management, or AUM for short, which the financial world defines as the current market value of the investments managed by one of these firms on behalf of clients. In the case of Vanguard, this AUM number will most likely reflect their index funds and ETFs in their main line of business, where they make the investment decisions and charge a fee for it. Assets under management are often the basis for determining how much revenue a firm might make from fund fees and so on. Please do note that there's also a second measure for how big these firms are: assets under administration, or AUA for short. Assets under administration reflect the total assets for which a financial institution provides administrative services and may also charge a fee for doing so. In the case of Vanguard, their assets under administration would measure all the assets in their brokerage accounts that they hold on behalf of their clients, including third-party funds where the investment decisions are made by someone else, like BlackRock. We couldn't find any assets under administration number for Vanguard, but this shouldn't be too much of an issue here when we try to understand their revenues, as assets under administration usually generate much less revenue than assets under management. Sometimes assets under administration may even earn no direct revenue at all, such as in the case of treasuries that are usually held for free in most brokerage accounts with leading firms, as many in our community know and appreciate. But because I personally find these numbers almost always fascinating, let's just mention that as per the latest numbers we could find, Fidelity had $13.7 trillion in assets under administration, and Schwab, $8.5 trillion. And yes, Schwab's assets under administration at $8.5 trillion are significantly larger than their relatively modest $1.2 trillion assets under management here. And what this means is simply that clients hold many investments in Schwab accounts, but only a relatively small part of these client assets are Schwab's own funds. This won't come as a surprise to many in our community, though, as it is well known that Schwab's asset management business, Schwab's own funds, are still at a much earlier stage of development than for Vanguard or Fidelity. Moving on now to this column, we have the total clients or active brokerage accounts at the end of 2023. Vanguard's roughly 50 million total investors put them at a very similar size to Fidelity and a bit bigger than Schwab. The not applicable here is because BlackRock's direct clients are generally institutions. While folks like you and me can buy BlackRock iShares, we can't open an account with them. In this column, we have the number of employees, which Vanguard actually calls associates. At the end of 2023, Vanguard, with about 20,000 associates, was comparable to BlackRock with 19,800 employees. But they had significantly fewer employees than Schwab with 33,000, and Fidelity, with about 74,000 employees, was playing in its own league here, so to speak. Let's keep going with revenues in 2023, which is where things get a bit tricky for Vanguard because, well, they don't disclose this, as we discussed at the beginning of this video. The only direct source we could find was Wikipedia, which gives $6.9 billion in revenues for 2022. That was a starting point, but we wanted to dig a bit deeper and make sure we can check it at least roughly for plausibility. So, Vanguard itself only discloses that the overall asset-weighted average U.S. fund expense as a share of 2023 average net U.S. assets comes in at 8 basis points. And yes, this is a mouthful of a description for a modest 8 basis points. But to summarize our detailed thought process, and for purposes of this analysis, we assume that these 8 basis points on their assets under management should roughly give us the income stream they generate from managing their funds. Now, Vanguard will have other ancillary income streams as well, and spend some of the fund expenses for third parties. But to keep it simple, let's just stick with the 8 basis points as a number that may not be that bad overall in terms of order of magnitude. If we apply these 8 basis points to the $9.3 trillion in assets under management that Vanguard had at the end of last quarter, this would give us $7.44 billion in revenues as a yearly run rate. Let's round this up to $7.5 billion. And we're getting close enough to think that this is a not implausible number when we compare it with Wikipedia's $6.9 billion in revenue for 2022. And yes, it did make our in-house detectives a bit proud that they were able to come up with a reasonable number for Vanguard's income based on the little data that the firm discloses. Please remember, though, that this $7.5 billion run rate revenue for Vanguard is our best guess estimate here at Diamond NestEgg, based on the little data that we were able to unearth on Vanguard, and will by nature be less precise than audited numbers in an SEC required 10K, like these from Schwab and BlackRock, or even these numbers here that Fidelity publishes itself on its website. So, at approximately $7.5 billion in revenues, Vanguard is substantially behind Fidelity, Schwab, and BlackRock, as you can see here, which should actually not be too surprising given their low-cost approach and more focused, narrower business model. Moving on next to operating income, or income before taxes in 2023. We did our best, but we couldn't find any information here for Vanguard. But at least you can see here how the other 3 brokerages fare. In fact, Vanguard's total revenues before any expenses seem to be in the same order of magnitude as the operating income or income before taxes for Fidelity, Schwab, and BlackRock. In other words, the other 3 had about the same money left over after expenses, but before taxes, at the end of 2023 as Vanguard took in total over the same period. And because Vanguard has expenses as well, people, IT, their corporate campus, marketing, our analysis here leads us to conclude that Vanguard should be quite a bit less profitable than its three main competitors, and most likely substantially less profitable if I was to venture a guess. After all, they did announce some eyebrow-raising fee increases in July. More on this shortly. So, in this last column, we have the net new assets in 2023, which I think in a way tells us everything that we need to know about one of their key challenges. Given their size and brand reputation, Vanguard should not have the smallest amount of net new assets, which is what they have here. Rather, it should be selling even more products from this larger asset base. Or to say it in plain English, Fidelity, with a smaller asset base, took in roughly 3 times the amount of net new money that Vanguard did last year. So, if I were to summarize these financials here, Vanguard is still a force to reckon with in terms of size of assets under management, well ahead of Fidelity and Schwab, and in the same league as BlackRock. However, and that's where the challenge starts, Vanguard seems to generate the least amount in revenue by a margin, and has a real growth challenge at hand, with net new assets in 2023 growing the least amongst this peer group, which may explain the recent management shakeup at Vanguard. In February of this year, Vanguard announced that their chairman and CEO, Tim Buckley, would be retiring. Buckley had been with Vanguard for 33 years, including the last 6 as CEO. And here's the kicker. They didn't immediately name a successor to Buckley, which is generally viewed as an odd move in the industry. You normally announce the successor at the same time as a planned retirement. Finally, in July 2024, 5 months after this initial announcement of Buckley's retirement, Vanguard announced that Salim Ramji would join from BlackRock to be their new CEO. And again, this surprised many in the industry because as a former senior executive at BlackRock, Ramji is the first outsider ever to take the helm of Vanguard. Ramji has more than 25 years of experience in investments, capital markets, and wealth management, and was most recently global head of iShares and index investing, where he was responsible for managing a majority of the firm's client assets and evolving the iShares platform to provide an even broader set of innovative, low-cost products for investors globally. This recent management shakeup and installation of Ramji, who surely must have played a critical role in BlackRock's pole position amongst the world's largest asset managers, is probably one of Vanguard's first steps in tackling their lagging revenue and growth positions relative to this peer group. And of course, let's not forget the new fees that were also recently introduced by Vanguard, which are likely aimed at increasing this operating income number that Vanguard does not publicly disclose. Perhaps Ramji will add more high-margin business lines beyond what Vanguard has now, meaning ways for Vanguard to make more money and add more new assets. These could include advisory, or dare I say it, more higher cost funds, or something else altogether. But that's the future. For now, for you, if you're an existing or prospective Vanguard customer, the real question is this: what do you really want from your broker? Do you want a solid firm that has some of the best and lowest cost index funds and ETFs in the industry, but also with lower touch customer service, longer wait times, and more basic technology and user interface? Or do you want a higher touch firm with 24/7 customer service, better technology, and other bells and whistles that has funds comparable to Vanguard, but whose funds will likely cost a bit more overall in the long run? Because this is Vanguard right now. Vanguard's low margin main business line, its low cost funds and ETFs, and its slower growth rate means that it simply does not have the revenue or capital to invest in customer service, technology, and other bells and whistles, to the same degree that big brokerage firms like Fidelity, Schwab, and BlackRock do, because these firms do have other higher margin business lines that generate additional revenue and cash for them to make investments in such areas. And if you're okay with this, that's fine. Vanguard is a brokerage behemoth and a pioneer in the industry. They're unlikely to be going away anytime soon. And because I know there will be someone worried about how safe their money is with Vanguard, I've also linked these two SIPC videos in the first pinned comment below as well. So, going back to the question of what do you really want from your broker? If, on the other hand, 24/7 customer service, better technology, and other bells and whistles are very important to you, then you should know that it may take quite some time for Vanguard to get there on all these fronts, if they ever even get there. And you may consider a switch elsewhere. Keep in mind, there's no rule that says you have to have only one primary broker. I know quite a few of our Diamond NestEgg regulars have accounts with multiple firms. So that might also be an option to consider as well. A bit of diversification across brokers. Now, only time will tell which direction Vanguard's new CEO Ramji and existing management will steer the firm in, whether they will indeed add other higher margin business lines or simply keep on doing what they've been doing as a reliable and trusted low-cost index fund and ETF provider without all the bells and whistles. And we will be following the developments here at Diamond NestEgg. And if you want to follow along with us, then do drop a comment below and let us know. Also drop a comment below. Which group do you fall into? Have you moved some or all of your Vanguard portfolio to another broker? And if so, which one? Or are you still with Vanguard and happy, or at least happy enough with the decision? Or perhaps you're just watching this video because you're a lifelong learner, but you don't have any of your funds at Vanguard. I'm simply curious how Vanguard folks are feeling about all the recent changes at the firm, and I'm sure others in our community are as well. Whether you're still with Vanguard or not though, personally, I don't think there's a right or wrong in this instance. It's simply a matter of what's most important to you and what you're looking for in your broker. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to keep learning, and specifically about the easiest, safest, and most cost-effective way to start with bond investing during these uncertain times, then take a look at this video here on our 2024 bond courses. Or join our next live member Q&A on August 21st at 6 p.m. Eastern Time, 3 p.m. Pacific Time for all things fixed income, with highlights of the 2-year, 5-year, and 7-year T-note auctions. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership. See you again very soon with more brand new wealth building content for your financial journey.